Another busy morning as we here in Canada wonder about the possibility of Trump tariffs. Trump has also announced support for a major investment by Oracle, SoftBank, and OpenAI to build AI-focused data centers in the United States. It's just one of the stories that James Callahan is tracking. He's a portfolio manager at Barometer Capital Management, and he joins us here in studio. It's great to see you, James.
Great to see you too, John.
This is a very busy time for announcements, and the market is watching very closely, and it does key into some very important themes that make up the markets, like tech, which has all this growth, and AI specifically. So let's just start there. Even though there's worries about our trading relationship with the U.S., what did you make of this continued push for data centers built in America to fuel the AI boom?
So I think you're exactly right, John. It's tough not to feel like a cat chasing a laser pointer right now.
Yeah.
You know, there's so much in the news, of course, but it's great to see the wind at the back of the AI industry now in the U.S. And you know, we've kind of taken the view, let's sit back, we'll look at the whole field and see what is going to be important to the new president. And we can talk about some other themes later on, but it's nice to see overnight that AI now is a key theme. Maybe just to provide some context to the numbers that we saw, this is an extension of the already $100 billion announced by the SoftBank CEO during a Mar-a-Lago visit in December. And so the overall number announced will be $500 billion. What that looks like, we don't know, whether it will be $25 billion this year, $200 next year, whether it'll be $125 billion a year for 4 years. It's hard to say, so it's difficult to model, but what we do know is that when you sum CapEx expectations for the big cloud companies that are investing in AI, when you sum their CapEx expectations for this year, you get to about $250 billion, just to give an idea of the magnitude of that $500 billion number. Like, it's huge.
Yeah, I mean, my head is spinning with these numbers. I've basically lost count. The only one that I'm keeping in mind is Bloomberg has a team of technology analysts who have predicted that AI-related revenue, specifically from the generative AI theme, so all the spending components that go into that, presumably some of this is that, will be north of $1.5 trillion in less than a decade.
Yeah.
And so I think those numbers have really caught the attention of investors and raised the question of how you should be investing given where we're going. And I know these stocks have had a big run up, but so how are you thinking about investing tied to the AI boom?
Of course. So we have a name that we like. It's NVIDIA. It's been talked about,
Right,
ad nauseum, of course.
Yeah.
When you look at the partners that were on stage with President Trump yesterday, we didn't see the NVIDIA CEO there, but they are going to be the clear beneficiary of this. When you read the language that was in the press release of we're going to be investing money into compute power for AI, all of those dollars essentially are going to buy NVIDIA GPUs. And so while they weren't really explicitly mentioned, they weren't on stage, I think they're going to be the biggest beneficiary of all of this. And it's just another source of gigantic incremental demand that they've seen come so many times over the last 2 years. And so I go back to our strategy that strength begets strength. And that's what we're seeing with NVIDIA. It's a generational move, and we're happy to have caught it.
Yeah, it's amazing. And I over the last 6-8 months, there have been some really smart people who've made very smart cases for it's time to cash in on a stock like NVIDIA. I was looking at some of the estimates across the board on Wall Street just in the last couple of days, and I think this is the average, not like an outlier. Like there's analysts that would not be surprised to see revenue growth of like more than 100% over the next 3 years. So that's the exciting growth story. But I think this, even this deal particularly highlights another big theme area, which is the power needed for our AI future. So how are you thinking about the power ecosystem that is, which really is, it's not really around it, it's part of the story of the AI boom as well.
Exactly, it's intertwined. So this is something that we've thought a lot about over the last year. And kind of beginning of last year, mid-year, we spent a lot of time on nuclear. And so there were a lot of nuclear exposed names that we quite liked and worked quite well. And that they had their time in the sun, definitely. But what we saw from some of the announcements that hyperscalers made when they're going out to try and procure power is that the incremental nuclear likely won't be online until 2030 or post 2030. Like that's the date that Microsoft's deal with Constellation Energy restarts 3 Mile Island.
That was a big one, yeah.
When Meta put out their RFP for nuclear power, they want nuclear electrons by 2030. So what's going to bridge that gap between now and then? We think it comes primarily from gas. And so there are some exposures and names that we like through that vein that we can talk about that I think are perfectly positioned.
Okay, shoot, go for it.
Sure, so it's relevant, especially this morning, having just reported earnings, but GE Vernova. So this is the legacy.
It's the power component of what used to be part of the larger GE?
Exactly. So they spun out of GE Aerospace. Legacy GE split into 3 pieces.
Yeah.
Healthcare came out a little while ago. GE Vernova split from the aerospace business in March of last year and started trading under ticker GEV. And so what that business is comprised of are the natural gas turbine business, the nuclear turbine business that they bucket into a power segment. It also includes the windmill business, which hasn't been great, and that came through in some of the numbers this morning.
Yeah.
But I don't think many people own it for the wind business. The kicker is going to come from the natural gas turbine business, where they have more than double the install base of their closest competitor. They're just by far the leader. And we saw from CEO's comments this morning, they received in Q4 $9 billion of orders specifically for natural gas turbines to power data centers. So they're just going to work really well.
Okay, and I will add that there's a pretty strong belief on Wall Street that all of that momentum is going to help them with dividend growth too over the next few years. It's really been a standout name.
And management's clearly communicated that. They've been really good with the street. They've held 2 investor days in their short time being a public company. That's why earnings this morning were probably less consequential than they otherwise would be, is that they're coming off an investor day in December where they did give long-term targets.
Got it.
But to watch the trading, like they traded down 5.5% pre-market and are now, a bit positive. So
It's
good.
There's a lot of interest in these names, and we're going to take a break, James. Come back, talk a little bit more about that earnings theme. We had Netflix out with quarterly results today as well, and that stock popped. So more market coverage when we come back here on Morning Markets on BNN Bloomberg. We have moved into earnings season in a big way, and technology is getting attention, Netflix in particular. We've talked about how hot that stock has been today after a record quarter of subscriber growth. Let's bring back James Callahan, who is a portfolio manager at Barometer Capital Management, to talk about Netflix. I have to say, James, having covered technology companies for a long time, the most interesting point to me was back in 2022, when a lot of people were throwing in the towel on Netflix because the subscriber momentum was gone. And, people have a bit of a flair for the dramatics, depending on, what the quarterly earnings look like. Here we are now, after a 400 to 500% run up in this stock in a couple of years. So it's been a pretty amazing ride to watch. What are your observations?
Well, I think they've emerged the undisputed leader in streaming. And we can take it back even further, because I think the historical context for Netflix is important right now, especially given the massive quarter they've just had. So about 10 years ago, Netflix realized, hey, we're going to have to get serious about original content production, because all of the content that we're licensing that's owned by content producers, they're going to want to get into streaming, and that the price of that content is going to go up. So they invested substantially, lost money for years, figured out how to make great original content. The content producers who had come into the streaming market realized this is kind of harder than we expected that it would be, and have pulled back investment. So now Netflix is hitting their stride where they know how to make great original content, and they win awards all the time now. And it's cheaper to license content, so the platform's just gotten better and more robust. And it comes through in the quarter that they just reported, and it's great to be sitting in front of you. Well, Netflix is up double digits because we've been buying it for the last few months, and it's been a core holding for us. And really, the main number, which it is too bad that going forward they won't report this number anymore. They want to change their reporting standard. But net paid subscriber additions, they were expected to do 9 million. They did 19 million. And so that's just a hugely strong vote of confidence in their content strategy right now. We saw things like the Mike Tyson-Jake Paul boxing match last quarter. We saw the NFL Christmas Day football last quarter. Everyone's telling me to watch Squid Game Season 2. They're just firing on all cylinders right now, and so it's a really good situation, and the stock's benefiting from it this morning.
Just because I spent some time working in Los Angeles and I got to know Ted Sarandos, who serves in a co-CEO role now, I think it's important to remind people that there was a point where everybody in Hollywood did not think that Netflix would be able to get this right. As much as the numbers tell the story, it is still a people business. And the one thing I noticed with him was, kind of reminded me, there used to be an NBC executive, Brandon Tartikoff, who just believed in creators and would take risks on shows like Seinfeld that other executives wouldn't necessarily take. So it was a focused plan, but not an overnight plan to get a lot of big creators on the Netflix team, and we'll see where it goes. I think some people would still like to see some more interesting shows, because everybody in content is always making interesting content. But on the stock itself, we already had an analyst at Morningstar this morning. He is very bearish, and he has a sell rating on the stock. He actually thinks it should be trading at around $700. So he said after the run-up, the valuation just doesn't make sense to him. Can you just explain to us, when you're trying to do analysis on a company that's had a big run, what do you think about?
So I come back primarily to what I said in the previous segment, that strength begets strength. It's the theory of reflexivity, that things will get better for longer than you expect them to. Things will get worse for longer than you expect them to as well. Yeah. That's kind of the core of our investment philosophy, and so we have no problem holding a stock that's had a big run-up in multiple. It's worked to our benefit many times. And especially with Netflix, they're a company that's proven they can go through multiple acts. I remember getting the DVDs in the mail. I was a kid, but I do remember getting the DVDs in the mail. And so, they've proven time and time again that they can navigate through many acts, and I think justifying a high multiple.
Okay, we're almost out of time, but we've talked a lot about tech. And when you look at the U.S. equity market, does tech represent the biggest opportunity, or are there any other opportunities you're going to be watching?
There are plenty. I do think that tech, from our strategy where we are looking for stocks that may fall into the momentum factor, there are a lot of areas of tech that have underperformed that may start to outperform going forward. But I think if I can put one idea in investors' minds now, you have to be on side with the president right now. As we are cats chasing the laser pointer, that's what's going to work going forward, and so that's what I think is primarily important.
Okay, James, good to see you. Thanks for stopping by.
Thanks, John.
James Callahan is a portfolio manager at Barometer Capital Management, joining us here in studio. We're going to stay on this earnings theme coming up. Procter & Gamble, the consumer products giant, coming out with its quarterly results. We'll get some insight and analysis on what's happening in the business of P&G here on Morning Markets. We'll be right back.